Hello, everyone, and welcome to Calling All Real Estate Investors with Caeli Ridge. We are here live every Tuesday at 1:30 p.m. Pacific time, 4:30 p.m. Eastern time for this live event with Caeli from Ridge Lending Group. So during today's call, please utilize our chat feature. If you have any questions throughout the call, we will answer them as we are able to. We love your participation. So really just throw anything in there. If it comes up, we will answer that as soon as possible. And today's topic with Caeli is going to be talking about amortized versus open-ended loans. She's going to talk a little bit about the differences of each loan, shed some light for you on their individual characteristics and what implications that has for the borrowers, so that when you're making your next loan, you will have more information on the subject. So thank you all so much, and I'll hand it on over to you, Caeli.
Thank you, Ms. Carly. Hi, guys. Happy Tuesday to everybody. Nice to see you. I am going to be pulling an audible today. Carly, I'm sorry. If I would have had more time before our live start time, I would have given you a heads up. So everything that she just said was a lie. No, I'm kidding. No, I'm teasing. Today had been planned to get into, as she said, the differences between closed-ended amortized and open-ended interest-only kind of revolving type mortgages. And while we can spend a little bit of time touching on it, I fear that I was not as prepared as I would normally like to be. I had some visual aids that I had put together or started to put together. They're not finished. So I'm thinking I'll give a quick overview, but I'd like to use today. There's a few other things that I wanted to share with you guys that have kind of crossed my desk that I think are timely. And then otherwise, I thought maybe we could just do Q&A stuff for things that are important to you that have come up in your day-to-day real estate investing journeys. So this may end up being a very short Tuesday live with Caeli. We'll see. Okay, so just for anybody that's brand new that may not understand conceptually, I'm going to give you the quick definitions of amortized and closed-ended and open-ended revolving interest only. Happy to answer any questions, but just note that we're going to really take next Tuesday. I will be more prepared to present with those visual aids and even some take-home stuff. There'll be some amortization tables that we'll post on the community that you guys can have access to. I'll be sharing and showing those during next week, so you'll see them, but you'll also have access to them on the community if you want to use them for your own uses or reasons. I'll do that first, and then we can get into some of the Q&A and other topics that I mentioned. So amortization is when you are going to take a mortgage, in this case, I'm going to use mortgage as the example, and you're going to utilize over a period of time the amount of interest that you're going to pay in order to make that payment more manageable or more palatable. For an example, a 30-year fixed mortgage is the most common in our industry, where you're taking $100,000 that you've borrowed at a rate of 6% or whatever it is, and they're going to stretch that payment out over 360 months, which is the equivalent to 30 years. 30 times 12 is 360, and come up with a principal and interest payment that is much, much lower than if the amortization was, say, 60 months. So take a car loan, for example. Car loans are what? They max out at 72 months. Maybe it goes to 84, I think, in some cases. I don't know. But the shorter the amortization, the higher the payment. Okay, it's actually quite unique in the United States that we have access to 30-year fixed money. It's very, very rare. There's only a handful of countries on the planet that have mortgages that will last or amortize over 30 years to keep that payment as low as possible. Most countries might offer 5 years, maybe 10 years. 10 years is kind of a high end of what the amortization is like. And if you think about it, if you've ever looked at an amortization table before, or you understand how that math works, that's a huge difference in payment between 120 months, which is 10 years, or 360 months. It's closed-ended, amortized and closed-ended. Closed-ended meaning that for every payment that you make, it's cutting down a little bit of principal on the front end. Usually you don't start plunking down the principal till the back end of that loan. It's mostly interest, as most of you know. But when you make that payment, let's say you make a little bit extra. Let's say your payment's $1,000 a month, and you wanted to try to accelerate the payoff of this mortgage, and so you're going to send in every single month $1,100 or $1,200, whatever it is, what happens to that extra amount that you're sending in, right? If your mortgage is $1,000 and you send in $1,200, that $200, yes, goes directly to principal, but do you have access to those funds? Can you get them back at any point in time? The answer is, well, the answer is yes, but only by a full cash out refinance, right? So really it's no. The only way you're going to be able to access any of that capital back for whatever your use would be is a full cash out refinance, which in and of itself is everybody's favorite thing, to go through a refinance transaction and put in all of your vials of blood for qualifications and the closing costs associated of doing so. So it's quite restrictive in terms of how to use arbitrage as a way of maximizing paying less interest and the flexibility of having access to your cash. So close-ended, amortized, a lot less flexible, more secure, right? Your rate is usually going to be fixed for whatever period of time, but it doesn't give you some of the added benefits that, say, an open-ended, and I'm going to do a quick pros and cons between each. Pivoting to open-ended, revolving, interest only, very, very different animal. This is where none of the payment goes to principal, only interest, and that might be okay. It depends on the deal and the property and how long you're going to have it, et cetera. But every deposit or every payment that you make over and above that interest only payment also goes straight towards the principal, but you have access to get it back at your discretion. So just the basics between those two, based on a variety of variables that we would have to identify based on your goals, will ultimately drive the point on whether this option for funding is better than this option. A lot of times, especially for real estate investors, under normal market conditions, and we haven't had normal market conditions for probably, well, truly over 10 years, right? Normal to me is post 08, 09, but certainly the pandemic, I would say 2018 would have probably been the last time, maybe parts of 2019, where an open-ended interest-only loan product would have been my preference. So keep that in mind when I'm talking about this. But under normal market conditions, I love an open-ended revolving interest-only product, or even if it's not revolving, even if it's a 5-year fixed interest only, I love that product because it gives you more control. And because investors, typically the shelf life of any traditional mortgage is about 5 years anyway, 3 to 5 years for most rental properties. And you don't start really even paying principal on a 30-year fixed mortgage until you're 11, 12. The interest only is usually a nice option. Now, I think that in the coming year, maybe 2 years, interest only products are going to be more viable. Remember, I said that we're not in a normal market condition environment. So interest only probably doesn't make sense unless we're talking about the all-in-one, which isn't necessarily what this context or this conversation was supposed to be about. Although I suspect next week when we really dive into it, we'll spend some time looking at it and talking about it. But I've always been a fan of either an open-ended revolving interest only or a 3 or 5 year ARM interest only. We'll come back to that. Anybody have any specific questions about amortized versus principal and interest amortized, closed-ended versus interest only, open-ended revolving accounts for mortgage related stuff? Anybody have anything about that before I pivot?
For everyone who just joined, you can go ahead and put your questions in the chat, and then we can answer them from there. We did get one from Gloria here. I think you touched on it briefly, Caeli. She asked, is this the all-in-one, the interest only? So you did briefly touch on that, and maybe we'll get more into that next week.
Yeah, we will for sure. Thank you, Gloria, for the question. To answer your question specifically, this isn't just the all-in-one. While the all-in-one is an interest-only product, it's really more about defining the differences between an amortized mortgage and one that you're paying principal and interest, regular payments, versus interest-only is really more the context of what the discussion will be. So more to come on that when I'm more prepared. For those of you that are joining late, today's discussion was interest-only versus amortized. The differences, what's better, when and why, et cetera. I have called an audible, and we will really be diving into that next week because I am not prepared. I had some visual aids that are not ready yet, so that's on me. But today, I'm going to go ahead and switch gears now then. I had sent, I don't know if you guys have all seen it, but we have sent out July's newsletter. talking about short-term and or mid-term rentals. There was some bullet points of some things in which we can do to better separate us from the pack, our short-term rental properties. For those of you, how many, if you guys, anybody want to just kind of raise your hand if you know how to do that, how many people today with us have short-term or have had short-term rental properties?
And while they're answering that, Caeli, we did get one other question. Basically, Glenn asked, basically an open-ended is similar to a HELOC then. Is that true?
Yes, open-ended will be a HELOC. You can have closed-ended interest only too, Glenn. They're not mutually exclusive. But open-ended, yes, would be a revolving, a credit card could be open-ended. A HELOC certainly is open-ended, yeah.
Perfect. Well, I did see a couple hands come up, so I think we had about, I don't know, 3 or 4 for your question.
Well, whether you have them, have had them, are going to have them, this time of year is timely because for many markets across the U.S., this is high season for short-term rentals. Again, newsletter this month for July kind of touched on some of that. I have been seeing reports, and obviously I get the publications, and I'm always reading things that come across my email and things related to, or the Google feed that comes up on my phone, related to real estate and the short-term rentals, Airbnb and VRBO stuff, is timely. But I've been seeing headlines and articles that are written that certain markets, every market is going to be unique. Anybody that starts to blanket statement stuff like short-term rentals are on the way out or whatever, and they just make it an overreaching blanket statement, I just shut off immediately because they don't know what they're talking about. But there are certain markets that are feeling some pinch, some pressure on the short-term rental space. And today's article was talking about this, in that they're finding that their normal, like from just comparing year over year, the number of days in this high market are down by 30% in some cases. And then the amount of rents that they're collecting are down another maybe 11, 12%. So the numbers are substantial, significant to capture people's attention anyway. And looking at that, I had an idea or just a thought that struck me. Well, okay, if that's happening, where are they? Because I believe in most cases, we still have the activity. I think that a lot of times, if the individual home, the single family residence or condo or 2 to 4 unit, whatever it is, isn't being rented, I think hotels are starting to find that their returns are increasing this year. I read another article unrelated, but that hotels are profitability levels are up. So looking at that side by side, or those two headlines side by side, it got me to thinking, why? What is it that consumers are getting or not getting with an Airbnb single family residence versus a hotel? Okay, what would those things be? The first thing that struck me, if it's me thinking about it, if I'm going to take and go on vacation, the nice thing about a hotel is all of the other extra creature comforts that you're going to get there, 24/7 room service, perhaps, concierge, all of those little nuances that you're not necessarily going to get with your single family residence, right? So how do we prepare ourselves, or what are some of the creative ways in which we can think about our own Airbnb single family residence that can attract those that may be otherwise looking at a hotel to spend their week or 2-week vacation of the summertime months. What about, and this is an open forum discussion, guys. So if anybody has been doing this or thinking of this or seen it or read it, it doesn't matter. Please feel free to interject. One of the things I thought about was, what about a voucher, like a DoorDash voucher or something? Good for $100 for any restaurant that's nearby. You could even go to the individual nearby restaurants or pubs or whatever, or start calling if you're not in that area, and talking to the owners if you can get a hold of them. If they're small enough places, you may be able to attract a certain concession, or if that's the one place that you have the voucher for, perhaps they'll give you some kind of discount on their fare. What else would be another good one? What else would you get at this just struck me this morning. I read the article this morning. What else would you get from like a concierge? So you could pick up the phone and call down to the concierge and say, hey, what is there to do in Palm Beach, Florida, right? Whatever it may be, and start calling some of the local area attractions or what have you, and find ways to ingratiate yourself so that you can get extra advantages or discounts for your tenants, your potential tenants, things like that. Does anybody have any stories or any offerings or feedback that you've seen or read or done yourself that might help with short-term Airbnb or VRBO properties? Come on, there's somebody on here that's got some anecdote or something they can share with the team, I'm sure. I
Well,
actually have a, go ahead, Carly.
Oh, sorry. I was just going to say, well, similar to what you just said, I just went on a trip with my friends, and the owner of the Airbnb sent us automatically after, you know, getting the property, a list of local things to do, places to go. So it was really fantastic. We went to one of the best restaurants I've ever been to, a great local spot. So it was just nice to feel like they knew the places around them, and I'm sure they probably do have some sort of personal connection to the owners, or just they like going there themselves. So that was really nice.
Recommendations, yeah.
Yeah.
And oftentimes, I mean, yeah, the Airbnbs that I've stayed at, usually there's going to be a little book, right? A book that has some of the local attractions, et cetera. But you got to take it a step further, especially if you're starting to see, for those of you that may be starting to see some decline in activity and how many days of the month that the property is rented, or the amount in which you would normally be renting it for, you have to plan ahead. Those are going to be important things to mitigate any downturn, because investments are cyclical. You guys have heard me talk about this maybe, I don't know, 4,000 or 5,000 times. Nothing's more true than that of real estate. It is going to, it's a cyclical nature investment. So you've got to be ahead of the game as much as possible. And I'm starting to see this more and more in the writings, and clickbait, fine, whatever, but I would be prepared for anything that you're looking at or you currently have short-term rental wise. Start doing some of your own due diligence to keep your property ahead of the rest, and the one that is rented the most and for the most money. Okay, that was what I had on that. What else? Does anybody have any questions about anything related to investing, finance?
We do have a question here from TS from a little bit earlier, and they asked, is interest only best with higher down for protection?
Tell me what you mean by that, TS. Can you expand on that question? I'm not sure I understand the question.
Yeah, I'll go ahead and ask to unmute you, and then you can let us know your question.
I was just making a comment that I think the best combination is to have a higher down payment and interest only loan for cash flow and safety for the product, whatever you're buying.
Okay, that might be true depending on the variables of the transaction. I think that, so I mean, let's just take interest only and take a few minutes and dig into that one a little bit deeper. So in comparison, I think I mentioned this, in comparison to a 30-year fixed mortgage, on a 30-year fix, the first 10 years of that loan, how much of it's going to principal? Very, very little, right? And if we know that on average, the shelf life of a non-owner occupied or investment property mortgage is about 5 years in duration, right? A lot, I mean, the vast majority of what you are paying every month is going straight towards the interest anyway on a 30-year fixed, right? Very, very little is going to the principal. And looking at an amortization table, you can see this every single month. If you had an interest only in the right market. And what I mean, let me be specific about what I mean when I say that. Interest only loans right now, especially for investment properties, are priced, the interest rate is priced such that a principal and interest 30-year fixed, more often than not, is going to generate a lower monthly payment than an interest only payment. So there's no incentive, right? It's defeated in this particular marketplace. When that flips back, and there is a substantial amount of savings, let's just say it's the difference in payment between an interest only in a normal market and a 30-year fixed is $100 a month. Okay, whatever. If you were to apply that whole 100 in my example with the interest only payment, you will actually crack down that principal faster on an interest only than you would on the principal and interest with the same payment that you would have had before without having to add anything extra. Now, taking that a step further and looking at it with an open-ended interest only product where you put in and you can take back out. Now that, Gloria, is absolutely the all-in-one, but you could do it with a second lien HELOC or any kind of open-ended line of credit that you may have attached to that property or not. The concept works no matter where it lives, the open-ended line of credit. But anyway, yeah, thanks, TS. Anybody else? Anything? Anybody?
Thank you.
You're welcome, of course. Let me think if I've got anything else that would be noteworthy for you guys.
Oh, we actually just got another question in, Caeli. Teresa asked, what options do I have for financing to purchase a multifamily? She owns a condo now that she doesn't want to sell. So would I have to live in the multifamily to get financing?
Thank you for your question, Teresa. No, and when we say multifamily, can I assume that you're talking about a 2 to 4, keeping it residential, a duplex, triplex, fourplex? Let's assume that that's the case. We'll wait for your answer. If it is, then no, you would not have to live in the property, although there are some strategies where house hacking, much higher leverage if you did live in it to get financing. If you're going to buy it as an investment property right out the gate, a 2 to 4 unit property, as a rental, you're going to be looking at 25% down for the best terms. You can find 20% down, but the rates will be a little bit higher than they would at 25. But if the numbers work, who cares about the rate, right? So the answer to your question is no, you do not need to live in it. You're going to end up putting more money down if you didn't live in it. Let's just use this and take it a step further. For those that are in a position to take advantage of a house hack, I absolutely love this strategy, where if you find something that you're okay with being your primary residence, a duplex, we'll use that for an example, you can get up to 95% leverage on that, even a little bit higher. FHA, 96.5% loan to value. You're putting very little down. Interest rates on an FHA are going to be, for an owner occupied, obviously better than a non-owner occupied. So high leverage, better interest rates, and you've got a tenant on the other side probably covering the majority, if not all, of the mortgage payment. And then when you're ready to kind of move on or upgrade into your own single family or whatever it may be, you still have this investment property. You get another tenant into the unit that you were living in. I think it's brilliant. It's one of my favorite strategies for investors to utilize, especially for the younger homeowners, right? It's a great way for, I've got a lot of my clients that teach their kids to do it this way, just to get their first toe in the water for real estate investing. They go out and they buy their first primary residence. They've got 3.5% down. It can be gifted because it's owner occupied and FHA rules allow for that. I think it's absolutely brilliant. Hopefully I answered your question, Teresa. Thanks. What else, guys? We got 7 minutes to the top of the hour. Going begging. Okay, then what we are going to do is I will absolutely come prepared next Tuesday. We will go into, there'll be some fun, but actually real quickly, I'll show you kind of one of the things that we're going to look at together. Since we have a few minutes left, I'll share my screen, amortization schedules. And you guys, you can get these anywhere. I mean, this is the one that I like. It seems to me it's the most user-friendly. Where did we go here? Share screen. Simple amortization. Okay, this will show you every single month for the duration of the loan. So you put the years in here. So if you put 15 in here, it'll obviously update. But this will kind of show you guys, well, if there were, well, I guess I'll not get into this, but it'll show you how much interest you're going to pay based on the loan amount and the interest rate that you've secured, et cetera. And then how much interest goes away if you were to make extra payments. It just kind of gives you, I don't know about you guys, but I like to have that visual aid and I like to be able to manipulate it and play around with it just to see how the numbers add up. And then taking this, we'll be able to kind of compare how quickly the interest only scenario can be repaid versus a fully amortized, right? So if you guys will just draw your, we'll do this again next week. So there's the payment. These are the terms, whatever. Okay. There's the principal, there's the interest. So the vast majority is going toward the interest, obviously. If you were to take an interest only, well, I'll show you guys this next week, but this will be one of the visual aids that I show you guys, and we'll make this available for you on the community site so that you can download it and mess around as much as you want to your scenario. Okay, no other questions, Carly?
No other questions.
Okay, gang, I will see you here next week. Thanks for showing up, and we're on standby if you need anything. Bye, gang.